Good morning, Flow Showers. Welcome to a new week. Welcome to the Flow Show. Hope you all had a good weekend, safe and peaceful weekend, and not got up to any mischief. Morning, K-Man. You been up to any mischief?
Mischief? No. Good morning, mate. Good morning, everybody. I've had a great weekend in company of my family over in London.
Nice.
Yeah, it was a really nice weekend. A bit tired though, so I need to get back into the groove.
Yeah, I know that feeling. No, I went the opposite way. I had a trip up north to Burnley
Oh,
because my son has been bugging me to take him to a proper West Ham away game rather than not one of the local ones. So, yeah, jumped on a train and headed up north for chips and gravy.
all right.
And
Hope you had a good time, mate.
3 points as well. So that was all good. Although he missed one of the goals because he was in the toilet. But such is life anyway. Right, let's get stuck into it. Quite a busy week on the data front. We'll take a look at what's coming up shortly, but we'll get through some of the headlines and stuff. Starting with China, PBOC still keeping their rate setting pretty low, 7.1159 versus 7.1151 previously. So no real change to the rhetoric over there. There has been, Bloomberg had a piece out saying that there's some seasonality that might be in play for yuan strength as we come into the last 2 months of the year, because the yuan has gained in November and December for 6 straight years. The reason being that exporters need more of the local currency to meet some cash demands before the year end and Lunar New Year. So a bit of seasonality there for you one traders like us. That'll be nice if that continues. And if that's the case, we might see dollar yuan moving a bit lower, yuan pairs moving a bit lower. We'll keep an eye on that one to see if that dissipates into the new year. In other China news, the NDRC is going to prevent iron ore hoarding and shenanigans by speculators. Iron ore prices have had a pretty significant jump of late, and apparently that's been put down to speculation and a bit of hoarding. So China's going to stamp down all over that. They're also going to support banks to sell bonds for loans to private firms. There was apparently a notice has gone out from the Chinese authorities to say that banks are required not to stop or withdraw loans to private businesses and to reasonably meet the financing needs of the struggling property sector, according to authorities over there. Now, it's a bit of a 6 of one, half a dozen of the other, because there is a hell of a lot of debt going on in there, particularly local government debt. So there have been moves to maybe rein a bit of that in, but on the other side, they want to prop up this property sector. So they want banks to keep loaning, not calling in loans, and not restricting credit to these firms. And obviously, if they get some PBOC backing to do so, that's what they will do. On the geopolitical front, Premier Lee says that China is willing to keep close ties with New Zealand. So some further, let's call it calm words or smoothing words to the Antipodeans. We know that Australia has been getting a little bit on their good side, or China's been a little bit less strong with what's going on with Australia, although Australia getting up to shenanigans with their navy around Taiwan the other day. I was expecting to hear some headlines from China against that. But ties there, so that's going to be a little bit supportive for the Kiwi, as it has been for the Aussie dollar. Not massively, but it's just another little tailwind you can put behind those currencies. Over in Japan, we had a bit of data out. I can't find it on this calendar unless I've missed it somewhere. It was the PPI numbers, but for the services sector in Japan, and it came in a pretty strong 2.3% year on year, up from an estimated 2.1%. and a prior number of 2%. So further strong inflationary numbers then, particularly in the services sector. As we saw from the PMIs last week, manufacturing went backwards, but services went forwards. And this is where they're seeing a lot of that inflation. According to the Nikkei, Japan is going to extend tax breaks on stock options. This is mainly aimed at small and startup companies to help lure workers into those businesses. So tax breaks on stock options that will be offered as part of pay packages to come in there. Meanwhile, Bank of Japan's Ueda, he's still taking a soft line of things. He's not ready to let things go just yet. He says there's not enough certainty on attaining the price goal yet, so keeping everyone's feet on the ground. Says that there's some positive signs seen in wages and inflation, but there is high uncertainty on whether this cycle will strengthen. And he also says it's too early to discuss how to unload ETF holdings. Now, on the wage front, one of the big metal workers unions in Japan is going to demand pay increases of 10,000 yen or more at a bare minimum, which will take those to the highest level ever and will be a wage rise of over 3%. So early days, but we're now getting some numbers coming in for what's going to potentially happen in the wages coming into spring next year, which at the moment seems to be the trigger for when the Bank of Japan maybe start easing properly. Going to be probably expecting a few more of these headlines, okay?
Yeah, it's going to be non-stop now between now and February, March. Yeah, and as you say, is waiting for those still, which in turn is keeping the yen on its toes. I was just looking at those JGB yields this morning. It's very quiet over there. Seems like the market has given up right now to try and push those 10-year JGB yields up to this 1% mark, which is going to be a big judge of strength or weakness of the Japanese bond market. Yes, we have been saying it a dozen times already. He's a very, very slow mover, the guy, and he seems to continue to keep this line, right? He may be changing a word here and there, but he does continue to keep a pretty firm line against to fight back against too much expectations in the market. So whether they move anything during there, I think that we have a meeting in December still. Whether he's going to surprise the market, I really doubt it. I really doubt it. It does seem to just continue his line, waiting for an extra round of wages before really pressing the button then.
Yeah, very much so. I think it feels like we're getting into that situation where, you're either coming in and talking the same old dovish lines and, not seeing sustained inflation and the market sells yen on that. I'm wondering if we just flip into a point where the market's going, we don't believe you anymore. You keep saying the same things, but we're seeing the data say otherwise. I don't know if we see that picking up into the end of the year because there's all sorts of stuff happening at the end of the year. But I think
it remains the same. If you would, we have been doing it for a while after the pandemic with regards to the dollar and the euro, because we knew that the Fed and ECB and other central banks like Bank of England, they were going to react. They had to react. But then Japan is a completely different story. If you start to trade, but we don't believe you, the data are better, and then you always run into the same issue. You buy yen, and then after a week being long yen, let's say for instance, after a week being long yen, you find yourself all of a sudden looking at a pretty big carry funding gap in your book, and that makes it so difficult to stay long yen for longer right now. We are going to need something from them, or again another round of weakness in the rest of the world. So we have seen those yields coming back down in the rest of the world, and that has helped the yen, at least temporarily, because it is temporarily. If you look at the dollar yen, we are two and a bit big figures lower than the prior highs. But then the euro, cable, you name it, all the others have done at least as much. Because if you look at the yen crosses, they're nearly back to their highs. If you look at the sterling yen, if you look at, well, euro yen, we're perhaps a big figure off. But then you look at all the rest, they're back at their highs. So it makes it still so difficult to be long yen if the rest of the world doesn't really slow down and yields come off. It's always the same issue, right?
Yeah, exactly. I think there's more. I think there's more opportunity to smash and grab in yen shorts now. I think that's what's growing. You know, you can if you pick your levels and you get a decent move, you've got more of a chance to at least offload a bit of the position, build up some ammo for the carry costs, if anything, while trying to keep
Absolutely.
the core short. But timing is everything. I'm getting a bit itchy now to maybe start doing something, but if I can, I'll hold off until the new year, just get over all the last of the end of year stuff, central banks and whatnot, and then it might be time just to try nibbling some shorts to see if stuff picks up over there. But that's something for the new year rather than now, unless we see anything.
Yeah, but as you say, you rightfully say, it's smash and grab. It's not like I'm going like full whack long yen and I stick it in the drawer and then I'll take it back out 6 months down the road. That's still too difficult, right? But the smash and grab, yeah, I agree. I think we are at levels. I'm not short yen anymore, unless it's also for a bit of a smash and grab somewhere. But I'm not really going short yen anymore either, because I'm seeing the slowdown happening in the rest as well. And so I think, yes, there are definitely going to be occasions to be a bit long yen, and perhaps, I'm not excluding that 2024 is finally going to be a yen year. And if you're right, you don't really care too much about the carry, because even if you pay, let's say, 0.5% or so away per month, which is about the differential. If you take 5% or 4.5% over a year, you're going to pay 0.3, 0.4% away over a month. That's okay, providing that the yen moves your way, right?
Yeah, exactly. Yeah, you don't want to be sitting in a trade that sits between what we're doing now, 147 and 150 for 3-4 months.
Oh,
otherwise, you just bleed in the money. But anyway, that's something I'm going to be looking at in the early part of next year. We'll see if the numbers add up. And as Kay often does, you can always look at the options, but I think they're going to start getting more expensive to the downside because the market is.
But then they are. But then equally, if you buy downside, the good thing is that you have paid already your swap away at the start of the move. So if you find somewhere, it's going to be a case to finding something where you strike the balance right between the funding that you're already going to pay away straight away in the option and the viability of a move. So you will have to find the right maturity as well. Perhaps looking at something 6 months or so. But again, timing is going to be of utmost importance, because if the rest of the world continues to zoom like a bit of buzzing away like it does now, and your risk markets like equities and stuff are not really doing too badly, it's also going to hamper the yen to make it strengthen for longer.
Yeah, very much so. Right, but anyway, let's move on for that for the moment. A couple of ECB bods popping up. De Guindos saying the current rate level for long enough will tame inflation. It also said that the euro area economy is stagnating in the second half of the year, and expects Q4 to look pretty similar to Q3. ECB's Muller says we probably don't need to increase rates anymore. Inflation is clearly showing a trend of slowing. Over to some of the data from last week. Canada retail sales was perhaps the big talking point, or the only real massive data point of Friday, ahead of the US PMIs. That came in pretty strong, the retail sales there. However, that was driven a lot by autos and gas. And there's one core sales here. This is just ex auto, so it's not full on core. That came in at 0.2. It's a little bit softer than the headline number. Still beat expectations. If you take out everything which exclude, or everything including gas, car dealers and other bits and bobs, sales are actually down 0.3%. So there's a little bit of skew in those numbers there from Canada. The market took it all positively anyway in that, and we saw dollar CAD dropping quite significantly, and we gained a bit since then, but still fairly decent move on those numbers anyway. The PMIs in the US, bit mixed, with again seeing this divergence between manufacturing and services. Manufacturing was expected to dip under by a couple of pips into contraction. It went a bit more than that, 49.4 in the end, but services beat expectations and rose on last month. So positive there from that took the service number probably outweighs the manufacturing numbers. It's the bigger part of the economy. Last week we were talking about watching for these Black Friday, Thanksgiving events in the retail line of things, and there was records set for online Black Friday spending. Consumers, they forked out 9.8 billion on Friday, which was a 7.5% jump from last year. That's according to Adobe Analytics. This is just for online sales, which also increased as well. Other numbers from Salesforce showed that Thanksgiving spending rose just 1%. It rose, I think, 5.5% according to Adobe. That's just for Thanksgiving. And Black Friday sales, though, went up 9% year on year, according to Salesforce. So some good, strong, positive numbers over these Thanksgiving and sale events. We've obviously got Cyber Monday today, so we'll see how that does. How does that reflect into the complete retail picture? We won't know until we get the November retail sales numbers, which will come next month. But I have a feeling we might, if we're going to see weakness, we're going to see December sales falling off a cliff. That's what I'll be looking for from the US consumer. It all looks pretty now, but whether this is a final splurge in a sale period, and then we'll see whether that's maintained in December or if it falls off a cliff, meaning that things are looking a little bit tighter. As I say, with retail sales at this time of year, in the old days, you just took what the December numbers were. Now you've got to take November and December together, so you don't really get a clear picture until January as to what the consumer is looking like. But for these sales events, it's all looking positive. Lots of spending going on, so that should at least keep those consumer numbers buoyed for a while longer. What else have we got? I think that's it. Kay, you got anything you want to flag for us?
The questions that we had surrounding a bit of slowdown in, and especially in the manufacturing sector and on the employment front, it doesn't filter through in what we see. Sorry, on the claims, but it does look like this sector is starting to feel a bit more average, right, than we had, and I think we can compare it perhaps to what's been happening in the housing market. We saw this slowdown, but then numbers are not really confirming it. So, but if the manufacturing sector is starting to, I even read some people, some companies who start to lay off even people, and that could be something that we need to watch for the upcoming possibly NFPs or so, whether it starts to filter through finally. Because, you know, we had those big layoffs in the tech companies and stuff, but we never had really the reflection of it in the NFPs or in that report. So, but that is something that that caught my eye.
Yeah.
And but for the rest, I think you covered most of it. There wasn't really anything world shocking, right? Or
Yeah.
market moving. Really, a lot of opinions and bit warnings here and there, but nothing to really make a market move more than it does actually.
Yeah, obviously the US market shuts Thursday and for half of Friday, so we probably haven't got a true reflection maybe to some of those numbers. So today is going to be a pretty important day when the US opens, just to see how the Yanks fully reflect on all that data and what happened last week. So keep an eye for maybe a bit of a choppy open when the US get in. Just to answer Roberto, December retail sales, they come out. It's about a month delayed. So November sales we'll see in December. December sales we'll see in January. Just the way it moves over there. But you can get a little bit of insight from the PMIs and some, as I say, some of these fast online surveys from the likes of Adobe can give us a little bit of an insight. So we'll keep an eye on those if they come out for Cyber Monday, just to see what's happened today. But yeah, it's just something to keep an eye on. Horatio, all those sales have been put on credit. It's difficult with the US because credit cards are used as the main form of spending, whereas in Europe, the UK, we use what's called debit cards, which automatically take it out of your cash balance in your bank. Credit cards are used like that in the US. What we need to find out is how much credit stays there after the end of the month, i.e. if people overextended stuff on credit. And they also have obviously the financing deals and so on, things like that for higher ticket items. So that sort of stuff all comes out in the consumer credit data, the Fed data, and that sort of thing. So yeah, the same we will keep an eye on. Teodoro says copper is not confirming the joy. Yeah, there's a bit of disparity going on in some of the commodity markets. We're seeing gold looking stronger today. It's had a bit of a breakup. This is what I was fearing last week when I was trying some shorts up here. We had the break finally, and it's holding the break. We've had a retest down towards those levels, and we are holding the break. I thought we might get a move quickly to sort of the 15-20 area, which we have done. Bit of a spike, a few stops going off through there. This hold at the moment should give it the impetus to carry on moving higher, and then maybe we're going to be looking at some of the higher levels that we saw earlier in the year, up towards 2067, that sort of area. So got a bit of traffic coming in around 20, 45, 50 area. But as long as this break holds, then yeah, we should continue to motor on. A different story if you look at something like oil, which still remains pretty laggard and still pretty soft at the moment. You know, we've had this bounce. We've got all this OPEC stuff going on. It doesn't seem like the market's getting too bullish about what might come from that, which means that the price risk is if they do something bullish, i.e. coming with some steeper production cuts, longer extensions, that sort of thing. But as we've been talking about the data, you know, I still, again, find a bit of disparity between what we're seeing in data like the PMIs, particularly for manufacturing, which are still languishing a lot in the negative for a lot of countries. It's not a reason why oil should be going higher fundamentally, even if we're seeing supply coming down from all these production cuts. It's not as if demand is picking up hugely anywhere to soak it up. So yeah, here's one commodity that's looking softer, gold's looking stronger, copper's was looking all right, and then it's come off a little bit. Let's have a quick look. I know Dale follows this a bit more closely. If I've got it up here, there we go, delayed one. So we're still, again, we're not really doing anything massive. We're still fairly down on the year, so it's not looking strong. China, I keep repeating, it's not I don't think it's out the woods yet. We're not seeing anything really strong from China to suggest we get a pickup. Yeah, we're seeing iron ore jumping, but that's got some speculation moves behind it. So yeah, the commodity space is a little bit all over the shop. How do you think that features, Kay? Commodities do look a bit of a mess at the moment. I mean, if you look at the fundamentals, would you be steaming into commodities?
No, that's how should I say? That's buying the either global or Chinese rebound as well. If you think that China has hit the bottom, and you can see that that we had some of those spikes higher. If you buy rebounds, if you think that the global economy is not going to suffer too much, you can go into commodities. My answer right now is I don't know. I find it perhaps a little early, but ask me again a month from now. I can perhaps say like, oh well, perhaps 2024 is going to be that year. You know, and I also read a lot of money is still waiting on the side, speculative money, because they are still getting like a lot of risk-free cash in money market instruments and everything else, and I think that's still a bit of a break on those things. But if the global economy is doing all right and we get like a soft landing globally instead of a hard landing, if we see a bit of revival in trade relationships like we have now, you see these also Australia, China, New Zealand, China. The US is trying to make a point of that it's not going to completely decouple from China as well, but just de-risk. Then that could be a good indicator. But then you have to look really at for those instruments to go much higher is demand. So that is how is the economy doing. So if the demand comes back, and that's a problem also that oil is wrestling with right now.
Yeah,
it's the demand supply balance, and OPEC can cut, but if you still produce enough to satisfy all the demand, there's very little reason for us, because this is pure speculation, right? To start to buy a lot of oil and gas, apart from a bit of technicals perhaps, because there are technicals at play, of course. But yeah, so I think we may have a better view on this if we get a confirmation that those Chinese data have bottomed, and that the rest of the economy is not starting to really dive into recessions, which the global picture still says that we are not going to have any strong recessions right now. But you never know, right? If all of a sudden that big NFP domino rolls over in the US, we may be talking completely different in a month or two from now, and then those things are going to suffer as well.
Yeah,
but,
exactly.
You know, I mean, yeah, we are on levels where it could be interesting. You're looking at the nat gas where unit is asking about. I can look at the dollar stocky.
I was going to back that one over to you.
Yeah, it's one of the same things. I mean, it's the same theme, the same overarching theme that you're going to find in gas and oil, albeit with different sensibilities, because some parts of the world are much more relying on gas than oil, like for instance Europe. But in Europe, you will need to know whether the economies are going to stand up or not. And for the time being, the picture in the big engine, Germany, is muddling through perhaps some only technical recessions, but what I read globally going on over there is not really telling me that Germany is going to come back and we are going to go all guns blazing again. In which case, you might actually be looking at buying that gas. Otherwise, I don't know. I really don't know.
Yeah, I mean, for something like that gas, we're obviously getting into the seasonality of it all, and it really becomes a question of how cold or not winters are going to be. You know, we know,
as well.
Yeah, we know that
as
Europe
well. Yeah.
particularly in the UK as well, have obviously been sourcing gas from other places, and that would have all started months ago. So to see gas coming down, all this Russia-Ukraine stuff, it's put a bit of a skew into energy markets, because now, as I say, people have to shop around more. So you have to get tankers in from the US, and it's all been about building up stocks for the winter. Now, if winters are mild in the US, if winters are mild in Europe and the UK, then you're probably going to see prices coming off, because people won't be digging into those stocks as much. Yet, if we do get some really cold spells, and those storage facilities and the stocks get put under pressure, then you're obviously going to see that gas rising. So it's always this time of year into the new part of the year, it's more about seasonality than anything else going on, just to see how people are bearing up. And you never know what Russia may do coming into the winter as well. They can still mess around with stuff. So that's really what you want to be looking at for that gas from this point onwards. Kate, did you want to have a couple of things? I did see your other question, Roberta, about the VIX. Maybe have a look at that towards the end. But for now, I'll sling it over to you, mate, to have a look at a couple of things, and then maybe I'll take it back. Where are we going? There and there.
Okay, I'll straight away grab Unit's question there about the dollar stocky. So this is dollar stocky. I don't know what kind of position you have, Unit, but it's looking like the rest of the dollars, really, right? It's on the defensive. It's looking to go down. One thing is that we have to know that Swedish krona, barring its own issues that they had of prolonged Swedish krona weakness, barring that, it's really an accelerated euro, because Europe is their biggest trading partner still. So if the euro goes up, we usually see dollar stocky very docile and following. And as a matter of fact, right now, let me just check quickly on where euro stocky is. Yeah, euro stocky is also well behaving, a bit weaker. So we broke through this 1085, did a very good move lower in line with the rest of the dollars. We're on the 78.6 of this move here, so we may find a bit of support around here if you want, but the big support should be coming in around 1020s, 1017 here. This prior low, you see those prior lows as well. If ever it gets down there, keep a close eye on what's going on there, and also on the daily. If you look at this whole move higher here, and this one from after the pandemic low, this whole move higher, the 38.2 is also coming in around 1021. So this zone here, low 1020s, high 1010s. That's where your very decent support actually should come in. Okay, this is a zone that you will need to keep a close eye on, and if you look at it on the top side, you have a bit of a zone here. You see we stopped, retested, and that is somewhere between 1058 and 1063. Okay, so that's the levels there to watch over there. Okay. All right, Giuseppe. Yep. So that's your first zone to the top side that you should be watching. Okay. So those are like those three levels. The one we are on now could be already interesting enough to have a look at, and then those ones above and below. If we start to really get back over here, and that I wouldn't like it for Swedish krona as such. In the current context of the dollar, so maybe something will have changed in regards to the dollar if you really start to make it back up here, and that wouldn't be good news for the Swedish krona, in my opinion. Right, let's have a quick look and browse to what we are doing here. We are still monitoring this 109 40-60 zone on the euro dollar, right? 65, yeah. We're still in here. The end of month, all the models you will have seen by now are calling for dollar sales Looking at the equity moves, looking at the bond moves, that's all logic, but we've already done a fair bit of it. I reckon the dynamic hedges will already have done a bit of it. I've been talking in the room about where I think which currencies will be more affected by end of month and which are perhaps a little bit less. I have to know that also tomorrow we're still trading value date end of month, so it could get a little bit messy, but the moves have been pretty big on the equity markets over the course of the month. So what the market is calling for more dollar sales could still materialize over the next couple of sessions. So whether we are going to cap here is a bit the question. I don't have a clear opinion on this right now, but just monitoring this situation. If we start to get back down on the euro, I reckon for the next couple of sessions we may start to find bids again, and then perhaps print a high, and then towards the end of the month, I don't know. But it's still looking very big. The dollar is still looking very offered. Finding it back in the cable as well. We are through the 50% on of this July October move lower on the cable, which is around 125.90. I also think the prior spike highs lows around 125.40, 45. If we revisit it, we may find some more bids. I think sterling is one of the currencies. When you look at the FTSE, the equity market moves that may see a bit more demand even in sterling towards the end of the month. Will it be cable or will it be through crosses? I don't know, but sterling still looking pretty perky. And we can have a look at here at high 126s, even why not going up into the 127s or so before the month is over. Another one that I'm carefully looking at is this Aussie dollar, and the same thing happened here. We are through the 50%. I was highlighting this 65, 80, 85 after the 65, 20, 25 held, broken, held on a retest, and now we are moving higher, and we are moving through this 50%, moving through the 200 DMA on the Aussie dollar. This is still looking pretty good, and same relatively happens in the Kiwi. So for me, the way it's looking now is that we should in theory, why do I do the 3 arrows? We should in theory find demand anywhere closer to this, if we get a revisit, closer to this 65.25, 65.5, and then perhaps already 65.80, you know, depending on how much hedging there is still to be done before this month is over. Again, bit of a warning tomorrow, because you know when the market is trading value date end of month, what the US corporates may have to do. But this looks to me like there is a chance that we trade up in those high 66s before the month is over. We'll have to look at gold and silver, okay? Gold is pushing through. We have this zone 06, 05, 12, what I mentioned. We are pushing through. We are going to find levels on the way up, but this market still looks to be quite impulsive, and we are trying to push through here. Again, if you look at how this market trades, it does look like the metals are in for a very strong end of the month as well. In the immediate, keep an eye on this 0510, 03, 0510 zone on gold, but for as long as it holds, it has the potential to move into those 20s, 30s. And on the downside, I think now not going to say the panic level, but the level that the players are going to watch is probably around here somewhere. This spike high, retest here, and then the move higher, 85, 87. 1985, 87, that's where it should hold now if this move is to continue. Silver is impulsive. That's the least we can say about it. So we are looking at this longer term resistance around up at 25. But in the meantime, we've had this very good hold here that we were talking about before, and to me, it's already broken a pretty decent level, you know, in the 2406 0620 zone. That was already a pretty decent level to me, and we are making very short. There's not even been a resistance really around 2460. I think we're in for the test of the 25 zone, all right, and then we will see what happens. Perhaps as the month draw to a close and start the next month, if we can get a break and a foothold above 25, silver could push higher. I'm still long, and seeing what's happening there, still pretty constructive. For that to happen, this break here, I am looking at what the economy tells me as well. For as long as we're in soft landing, for as long as we don't enter bigger recession, this should be okay. If we enter a recession door, then stuff like gold should outperform silver. All right. So, but I'm still looking at the indicators, still very soft landish, and so this can continue to do pretty well. This silver as well. Anything else? Yen is a bit of a tough watch. Yeah, we are now breaking back through this first line of support here. No. I'm lying. This is where we tested again earlier today. That's 148 around 85, 80, 85-ish. Okay. But we're coming back to retest it all the time. So we're in a bit of a range here now with your top side, 149.75. For it to push higher, we are going to need to break above all this. We have already talked about that. That's your 150 and then above 150.40. It does look like we are finding good enough resistance on every push higher. I think that has to do with the dollar, because if you look at the crosses, they are not really coming off a lot, or at least they are not staying low. This is your euro yen. This is your Aussie yen already pushing back towards the highs. This is your Kiwi yen not wanting to stay low. We are actually already supporting these very long-term resistances that we had in the 89s. We're already supporting there, right? We came back below quickly on those spikes lower in the dollar yen, or fake or real scares, but we are already above. So that's what I'm saying. I mean, you can look at the dollar yen to trade something, but then if you look at the viability of a move, you still have to look at those crosses, and those crosses are still refusing to stay low. Look at what's happening in sterling yen, okay? So this is just to tell you, if you trade the yen, if you trade the dollar yen, you need to look at what's happening in the crosses as well. The crosses are going to tell you whether a move is viable or not, okay? Ryan, I think that's enough for me for today, you know.
Yeah, thanks, mate. I'll take it back quickly, just for a couple of things. You see my screen okay?
Yep, fire away.
Yeah, so here's the VIX for Roberto. You got to be careful with the VIX, okay? Because you got to know what it is, as well as what a lot of people infer it is. Obviously, it's a volatility thing. When things are volatile, obviously it rises. On one hand, you've got to look and think, well, you've got the war in Russia, Ukraine still going. We've got the Middle East stuff still going. You've obviously got these constant tensions with China. There's a lot of things to suggest why volatility should be higher on that basis. But then it is a measure of options volatility. So you've got to take that into account. What does the market see at the moment? Does it see a lot of volatility coming in to various assets? And the answer to that is no. Russia, Ukraine is contained in its own bubble. The Middle East thing at the moment is contained in its own bubble. So there is no, the market's seeing economies, okay, the US is doing okay, the rest are bumbling along. We're at the end of rate hikes, rate cuts are coming, but nothing to suggest that central banks are seeing a big contraction or economies are going to fall off a cliff or things like that. So when you get that sort of sentiment generally in the market, there's no reason to take added protection via the options and therefore seeing volatility rise. So is it a green light for stocks? How do you want to perceive it? Perceive it any way you like. Stocks are going to do what they're going to do anyway. Volatility can keep coming lower. or it can jump up a bit into the end of the year. Who knows? You've got to swing with the punches. If you're looking at this to trade equities, don't look at this too much. Otherwise, you might as well trade this rather than equities. If you're spending too much time looking at the VIX to worry about what equities are doing, then just trade the VIX. Don't worry about equities. So yeah, that's, as I say, with the VIX, you've got to know how to read it sometimes and what it's inferring and what it actually is at the time. Right, just lastly, before we switch off, I just wanted to have a quick reflection on what we've got coming up. Quite a busy week this week, more housing stuff. The main US consumer confidence number coming in tomorrow as well, so keep an eye on that. We see all inflation expectations rallying or rising in the final Michigan number last week, so we'll see if that's matched in the conference board numbers. A few more bits and pieces coming in from GDP, but we also get some flash CPI numbers from around the grounds, so that's going to be important, lining up for the last central bank meetings of the year coming up, so we'll keep an eye on those. No jobs report this Friday, even though it's the first of the month. They don't run jobs reports on the first of the month when it falls on a Friday, except when they did in September. I still don't know why. I think that might have been because of Labor Day or something. So no jobs report, US jobs report on Friday, although we do get the Canada number. And then we get some final PMI numbers for manufacturing coming out, as well as the ISM dropping on Friday as well. So plenty of data really to keep an eye on this week. And as I say, it's going to get important for knowing what's going to happen at these last central bank meetings of the year. And on that note, we shall call it a day for today. Get you all, hopefully we've got you all set up for the week ahead, know what you're doing, know what we're looking at. And good luck with your trading this week. And thank you very much for coming to the Flow Show. Thank you, K-Man, as always. And we will see you all tomorrow.
Thanks, everybody. Have a good week. Thanks, Ryan.
Cheers, mate.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.